Welcome back. Our mission is to provide our readers with in-depth and insightful analysis of the global financial landscape, focusing on key areas such as currency markets, investment trends, and broader macroeconomic developments. We aim to serve everyone from investors and travelers to global economics enthusiasts, delivering timely, accurate, and relevant updates to help inform smarter financial decisions in today's rapidly changing world. In this edition, we shift our focus to a currency that often gets overlooked in Western-centric financial discussions but plays an increasingly vital role both regionally and globally, the Vietnamese dong, VND. While not as widely traded or talked about as major currencies like the US dollar or the euro, the Vietnamese dong serves as a vital indicator of the dynamic and growing Vietnamese economy. To truly grasp its significance, we'll explore the historical context of the dong, the mechanisms behind its valuation, and how it plays into the country's evolving economic strategy. The Vietnamese dong is more than just a currency. It's a direct reflection of Vietnam's historical journey, encompassing its political, economic, and cultural transformation. Before the reunification of North and South Vietnam in 1975, each region issued its own currency, a situation that highlighted the economic disparities between the two. The end of the Vietnam War and the reunification of the country led to the establishment of a single currency, which not only served as a financial tool, but also symbolized national unity and a new direction for the economy. The post-war period marked the beginning of an ambitious shift toward self-reliance and recovery, albeit initially through a centrally planned economic model. Over time, the Vietnamese dong has evolved alongside the country's broader transition from a centrally planned economy to one that embraces market liberalization. This shift, which began in earnest with the introduction of the Doi Moi reforms in 1986, fundamentally altered the Vietnamese economy. These reforms laid the groundwork for privatization, the expansion of international trade, and the liberalization of key sectors, significantly boosting the country's GDP, exports, and industrial production. As the country transitioned, so too did the dong, becoming increasingly reflective of the market forces at play, though still tightly managed by the State Bank of Vietnam, SBV. Vietnam's economic diversification has played a central role in the growing international importance of the dong. With the country moving away from an agriculture-driven economy toward manufacturing and services, foreign investors began to take notice. Vietnam was increasingly seen as an attractive alternative to more expensive markets like China. The dong, therefore, not only functions in domestic transactions, but also serves as a symbol of Vietnam's growing economic resilience and its ambitions on the global stage. Despite its progress, the Vietnamese dong remains undervalued compared to major global currencies such as the US dollar, the euro, and the Japanese yen. This undervaluation, however, is not a market anomaly. It is the result of deliberate policy decisions by the State Bank of Vietnam. By keeping the dong's value lower relative to other currencies, the government ensures that Vietnamese exports remain competitively priced on the global market. This strategy benefits key sectors like textiles, electronics, and agriculture by making Vietnamese products more appealing to foreign buyers. However, the approach also has its drawbacks. An undervalued currency can lead to inflationary pressures domestically, eroding local purchasing power and raising the cost of living for Vietnamese citizens. For investors, the undervaluation of the dong presents a complex set of risks and opportunities. On one hand, there is the potential for appreciation and profits if the dong strengthens. On the other hand, investors are exposed to significant risks stemming from shifts in government monetary policy and macroeconomic instability. The Vietnamese dong operates under a managed floating exchange rate regime, where the State Bank of Vietnam allows the currency to fluctuate within a predetermined range, but intervenes when necessary to maintain stability. This system helps to prevent wild swings in the currency, which could disrupt trade and undermine investor confidence, especially in a developing economy like Vietnam's. The SBV sets a daily reference rate for the dong and allows it to move within a narrow band, typically around plus of 5%. This flexibility provides some leeway for market forces while keeping the currency within a controlled range. However, this tight control means that the performance of the dong is often more influenced by government actions than by pure market dynamics. Although this approach has helped Vietnam avoid major currency crises and maintain macroeconomic stability, it also limits the transparency and autonomy that many international investors prefer when allocating capital. Despite being one of the weaker currencies in Southeast Asia compared to other major global currencies, the Vietnamese dong has steadily garnered attention from investors looking to tap into Southeast Asia's growth story. With Vietnam's strong economic fundamentals, such as consistent GDP growth, increasing exports, and a youthful tech-savvy workforce, the country is becoming an increasingly attractive destination for long-term investment. Major multinational corporations, including Samsung, Intel, Nike, and LG, have established significant manufacturing operations in Vietnam, boosting employment and industrial output. These developments further enhance Vietnam's credibility as a rising economic power, thereby reinforcing the importance of the dong in regional and global trade. For investors seeking exposure to Asia's next wave of growth, holding VND-denominated assets offers a unique opportunity to access a vibrant, export-driven economy. However, this opportunity comes with risks, most notably in terms of currency volatility and the influence of centralized financial governance. The dong's appeal lies in its potential, but entering this market requires careful planning, as well as a keen understanding of the macroeconomic trends at play. Investing in the Vietnamese dong or any emerging market currency carries a set of risks that cannot be ignored. Currency volatility is one of the primary concerns, as the VND can experience significant fluctuations due to both internal factors, such as changes in economic policy, and external influences, like global commodity prices or trade disruptions. Vietnam's heavy reliance on exports means that a slowdown in global demand, especially from major trading partners like the US, China, or the EU, can quickly impact the value of the dong. Furthermore, the currency is often subject to interventions by the central bank, which can sometimes create conflicts with broader market expectations. This introduces an element of unpredictability, making long-term planning more complicated for investors. Inflation is another key risk to consider. While Vietnam has managed to keep inflation relatively contained in recent years, sudden shifts in consumer prices or policy missteps can lead to devaluation. These economic dynamics underscore the importance of adopting a cautious and diversified investment approach when dealing with VND-denominated assets. For international travelers, the Vietnamese dong presents a set of practical challenges. Due to its low relative value, denominations of the dong are quite high, with common banknotes ranging from 10,000 to 500,000 VND. This can be confusing for those unfamiliar with the currency. While Vietnam is becoming more integrated into the global financial system, cash still dominates everyday transactions, especially outside major urban areas like Ho Chi Minh City, Hanoi, and Da Nang. Travelers should always exchange currency through reputable sources, such as banks or licensed money changers, since airport kiosks, hotels, and unlicensed exchanges often charge high service fees or offer unfavorable rates. Though credit cards are becoming more accepted in urban centers and tourist zones, they remain relatively uncommon in rural areas. Travelers are also advised to stay mindful of real-time exchange rates and transaction fees, which can help maximize spending while exploring all that Vietnam has to offer. Vietnam's continued integration into global trade networks highlights the growing importance of the Vietnamese dong as the country increases exports in key sectors like electronics, apparel, and agricultural products. As global demand for these goods rises, the need for VND-denominated transactions may also increase, suggesting a potential long-term strengthening of the currency. If coupled with ongoing policy reforms aimed at improving transparency and strengthening the financial system, the Vietnamese dong could see increasing stability and appreciation. The Vietnamese government has made strides in improving its investment climate through reducing red tape, enhancing regulatory oversight, and encouraging foreign direct investment, FDI. However, challenges remain, such as corruption, bureaucratic inefficiency, and occasional policy unpredictability that continue to pose hurdles for both local businesses and foreign investors. The future of the dong will largely depend on how effectively the government addresses these issues, as well as its ability to manage the complexities of inflation, trade relations, and global economic shock. Looking ahead, the Vietnamese dong is unlikely to experience dramatic revaluations. Any appreciation will most likely be gradual, carefully managed to avoid undermining Vietnam's export competitiveness. However, should the country continue its path of economic reform and global integration, the dong could strengthen steadily over time, driven by improved market conditions and increased foreign investment. In the context of Southeast Asia, the Vietnamese dong occupies a particularly strategic position within the Association of Southeast Asian Nations, ASEAN. As one of the region's most dynamic economies, fluctuations in the dong often signal shifts in regional supply chains and trade flows. For investors and analysts, monitoring the VND is not just a way to track Vietnam's economic progress. It also serves as a bellwether for the broader economic health of Southeast Asia. As we continue to watch the Vietnamese dong, we'll be tracking these interconnected factors: Vietnam's economic expansion, shifts in regional trade, and the evolving role of the dong in global finance. For investors, it opens up early mover opportunities in an undervalued asset class. For economists, it provides a window into how monetary policy, foreign investment, and global trade intersect in an emerging market economy. For global business leaders, it serves as a reminder of the growing significance of local currencies in shaping international strategy. Thank you for joining us for this in-depth exploration. Stay tuned for future editions where we'll continue to provide insightful analysis on global currencies and financial trends right here on Iraqi Dinar.